这个虚拟画的也可以用是吧？这个就是直接是画的还没啥效果。但是这个没有用，没用，这个拿过来是这样子。比昨天还少，今天是吗？8点钟时间很尴尬，就正好堵在校园，就是车子。对，哎呦，这个是你的时候。Okay, good morning. Yesterday we have introduced the chapter 1 and 2, and the chapter 1 and 2 is about first one how securities are traded. So in this chapter we introduce some mechanism in the stock market, and after that we introduce something about how to calculate the margin in the normal trading and the short sales. The calculating methods are different in different situations. This is the first chapter about stock trading. And second one is about how to allocate your capital into the risky portfolio, risky assets, and risk-free assets. So we also introduced some methods about how to calculate. And we still remember that there are two ways to calculate. The first one to calculate the Y star. Y star means the optimal value of the risky assets. The first way is to calculate it just by you can draw a line, you can draw a curve, and we can find the highest point to get the best utility value. And the second way that we can also use the indifference curve. We can draw a series of indifference curve. And in that case, we can also find that according to the different risk aversion and find which is your optimal point about the how to allocate the risky assets and risk-free assets. Okay, so this is something about yesterday's chapter 1 and chapter 2. And after you determine the proportion about how to allocate your capital, then if we determine that 80% of your assets can be divided, 80% of your asset of your capital should be put in the risky assets. In that case, in the risky portfolio, we know there are a lot of things to invest, like stock, funds, different kind of funds, and also you can invest in the options and futures. So we should move to the next step. How to allocate, how to do the security. The second step, asset allocation across broad asset classes, and last one, security selection of individual assets with each asset classes. So this is what chapter 3 focus on the third step. Okay, so yesterday we stopped here. Okay, we should know the difference between the market risk and the firm's basic risk. They are totally different. And yesterday we talked about sometimes you know situation is very bad. So in that case, almost all the stocks will decrease in the stock market. So that is market risk. So the definition is that risk attributable to market-wide risk sources and remains even after extensive diversification. In the normal case, if you have enough company, then maybe there is low risk because they will have because the diversification will give you some advantage for investment. Like this stock increase, that stock, like stock A increase, stock B decreases. Okay, so in that case, maybe there is no risk, almost no risk. If the diversification is enough, then there is almost no risk. But market risk means that the market situation is really bad. So even you have enough diversification of your assets, but it still has a very high risk, and you cannot control the markets. So also called systematic or non-diversifiable in this case. So this is the market risk. And in another way, firm's basic risk means that risk that can be eliminated by diversification. That means if the number of the company is big enough, that there is almost a risk. So it is also called diversifiable or non-systematic. It will not affected by the markets, by the situation, the economic situation. So they are different. So maybe from this figure, it's easy for us to understand. This means our risk is firm's basic. In this case, if the x-axis means the number, the y-axis means the variance mean the variance, which means the risk. In this case, y-axis mean the risk. So if the number is big enough, so we can see that the risk is really decreasing. It's decreasing. But the second figure means that some risk is systematic or market-wide. In this case, the market risk cannot be divided. We cannot divide and we cannot decrease the market risk because it is very stable. It is very stable in a very stable level. So in this case, you can only increase the number of the stock, but you can only decrease the second kind of risk, firm-specific risk, but you cannot decrease the market risk. Okay, so from this figure, we can know the portfolio risk and the number of stocks in the portfolio, their relationship. And this is a figure based on the data in the Chicago stock market. Okay. In the real stock market, this is number from the real stock market. Okay, so from this one, this is number maybe from Chicago stock market. Okay, so we can find this is almost the same with the previous PPT, the previous page. The previous is an ideal model, and this is real data from the markets. So in that case, we can see that the risk is really decreasing when we increase the number of stocks, but the level of the market risk is very stable. In that case, it's like in this way, it's very stable. So it cannot decrease into zero. It's impossible. Okay, so this is portfolio diversification. And we can see that portfolio risk depends on the correlation between the returns of the assets in the portfolio. So in this case, if you increase the number, then the portfolio risk will decrease in our normal sense, okay? So the covariance and the co-relationship coefficient provide a measure of the way return of two assets move together. So sometimes if two assets, if they have the linear relationship, so we can use this kind of covariance to calculate the covariance, the co-relationship to calculate the coefficient if the two assets are in a linear relationship. But in most of the case, if your assets is not stock, if your assets are not only stock, but options and futures, in that case, we cannot see that it is linear relationship. And also in that case, we cannot just use the covariance to calculate. That's very complicated. If two assets are nonlinear, in this case, for example, options and futures, in that case, how can we calculate? We cannot use covariance. We should use more complicated method to calculate, like a Kopla function. If you find there are nonlinear relationships, so maybe you can use Kopla function, like a more complicated method to calculate. So in this case, only use covariance is not enough. So you must know that. And next, if we want to determine, don't forget, our goal in this chapter is to calculate if I have already determined 80% of my capital should be put in the risky assets. So in the risky asset, we have different stock. So how should I allocate my capital into different stock? So that's our final goal. If I want to introduce the logic relationship between the method, I should begin with a very simple case. The simple case means that you only have 2 risky assets. Of course, you can have more than 2, but in order to explain this easily, we just suppose that there are only 2 risky assets in this portfolio, in the risky portfolio. Okay, so like previous chapter, we should first calculate the return, expected return, and the variance. That means you should calculate the expected return and the risk first. Okay, suppose that the portfolio return is calculated by the weight. Suppose there are 2 risky assets. One is bond, another is equity. Maybe the bond is a long-term bond. If short-term bond, I think most of them are risk-free assets. So if the bond is long-term, in most of the case, because the time is too long, so we can say maybe it's a risky asset. Okay, so W means the weight of bond and the weight of equity, and R means the bond return and equity return. So in this case, we can calculate the expected return of this portfolio easily because it's linear relationship. So it's very easy. Just use the weight and the expected return. Okay. But if you want to calculate the variance, it's not so easy as the previous chapter, because in the previous chapter, we calculate the relationship, the variance and the expected return just between risky asset and the risk-free asset. So it's linear, because for the risk-free assets, there's no risk. So you only need to consider one factor, which is the risky asset. But in this case, we have 2 risky assets. So if you want to calculate the variance, it's more complicated than the previous chapter. That means you should use this function. You should consider this function and calculate it based on the covariance of B and RDN. You should consider the covariance. Okay, so based on this figure, based on this data, we can calculate the bond variance, equity variance, and the covariance of returns for bonds and equity. Don't forget, just now we mentioned the important parameter, which is called covariance. Just now I said that if you want to calculate covariance of returns, you should know the zone first. Zone means the correlation coefficient of returns. This parameter is very important, and this we're familiar with the standard deviation. But zone means that if 2 assets are linear relationship, just now I said that if the 2 assets are in a linear relationship, then you use those to calculate the correlation coefficient of returns. It's very good. It's a very good parameter. But if 2 assets are non-linear relationship, you cannot use those. Okay, just now I said that you should use like a Kopla function, this kind of things to calculate more accurately. It will be more accurately. Okay. Okay, so suppose that they are in a linear program, in a linear relationship. You should know that the range of values for those should be -1 to 1. It's moved from -1 to 1. If those equals to 1, that means the securities, the stocks are perfectly positively correlated. Sometimes maybe they are in the same field. Like Apple, like IBM, they're in the same computer field. So maybe the low is 1. If if the stock of one company increase, maybe other related companies will also increase. Maybe in the same percentage. In that case, though equals to 1. If though equals to -1, the stocks are perfectly negatively correlated. In this case, we can decrease the risk. Because we like stock A increase, stock B decrease. In this case, almost no risk because your capital will not be changed. So in this case, But in most of the situation, the zone is moved just between -1 to 1. This is the extreme value. So most of cases just between these two extreme value, 1 and -1. Okay, so this is the concept of zone. So we can see that here is more extension. When zone equals to 1, there is no diversification. Okay, so if zone equals to -1, a perfect hedge is possible. This is a hedging. This is a perfect hedging. So after the class, I will share the PPT and I send all the PPT to Miss Wang, and maybe she will send to you. Okay. So I will send all the files. Okay, next. After we get the relationship between the stock D and E, we call that stock D and E. We can calculate in this table. This is something like covariance matrix. In this one, we can see that covariance matrix and border multiplied covariance matrix. You should calculate the covariance between all the stocks, because in this case, it's a simple one. It's a simple only 2 assets. So if there are more than 3, 4, 5 assets, every time you should calculate if you have stock A, B, C, D, E. Every time you should calculate the relationship between AB, AC, AE like this. So it's a little every time, okay? Covariance RID. So AB, AC, AE. So that's a little complicated to understand. But finally, you just calculate the sum of all the covariance. It's based on the covariance and their weights. So I think it's easy to understand. If the number is large, of course you can use the mathematical function about matrix. I think it's also easy. And after that, we get a line. This line is a little similar with the line that we introduced yesterday. We still remember that yesterday when we talk about the relationship between the risky asset and the risk-free asset, there is still a line. The line is CML, capital markets line, CML. In that line is from the, don't forget, the line is from the risk-free assets, like 80% is from here. So very similar. But this line, don't forget, what is the difference between the line here and the line we used yesterday? Is very similar, like from here to here, okay? The difference is that the x-axis that we introduced yesterday is sigma. X-axis is sigma. Y-axis is expected return. But today, the y-axis is expected return, but x-axis is not sigma, it's weight of the stock, So that's why we call it, this is the portfolio expected return as a function of investment proportions. So if we consider this line and also the proportion of the different assets, also we consider based on the different value of zone, like zone equals to 1 minus 1, 0, 0.3. So what will happen? How can we get the relationship between if you want to determine the best proportion of the different stocks, we should calculate the relationship. We should know the relationship between the expected return and the sigma, okay? But in this case, we cannot get the relationship between the expected return and sigma directly. We cannot get that directly. So let's find a way, something like indirect way. If you find the relationship between the expected return and the weight, Then next, you can find the relationship between the sigma and the weight. Then combine it together. Then we can easily get the relationship between the expected return and the sigma. Like something like the weight is a bridge to connect the relationship between the expected return and the sigma. Okay, let's use it this way. So first, you should know the relationship between the expected return and the weight of the stock. Okay, so if rho equals to 1, it's a line, it's a straight line. If rho equals to -1, it's like this, like a V, okay? So in the normal case, if rho equals to 0 and 0.3, we can find that it's like a curve, okay? So this is the first relationship. It's about, okay, this is the first one. X-axis is the weight, Y-axis is the expected return. Okay, this is the first one. And second one, X-axis is weight, Y-axis is the standard deviation. So the third one, if you combine these two pictures, of course we can get the relationship of the expected return and standard deviation. So this weight is just a bridge to connect the two important parameters. Then we get the third one. You should change the direction. Change the direction. Then we can easily get the third one. The third one means the relationship between the expected return and the sigma. Okay, so it's very clear. I think the relationship in this figure is very clear now. Just change direction. So rho equals to 1 minus 1, 0, 0.8. And now the problem is that which point is the best one? I said that if you want to determine the best point of the acids, the combination, how to determine the best proportion of the combination, like stock ABC. Now we only have stock A and B because I said that this is a simple example. This is the simplest example. We only have two acids, stock A and B, something like this. So in this case, how do you determine the best point to determine the best proportion for stock A and B? It should be determined by two important parameters. First one is your capital. How much do you have? Your capital. You should base on that. All the determinants should base on your capital. The second one is their relationship. And in this figure, we have already get the relationship between them. So which point is the best one? So we can find that which point is the best one. For this curve, actually, only this part is effect. This part from here to here almost make no sense. Why? Because if we draw a line, you can find that this is standard deviation. Standard deviation is risk. So if you draw a line, you can find that the same risk, same standard deviation, but here, this is larger than this one. This is larger than this one, right? Of course, so we don't need this part. We can just cut this part because it's the same risk, but the expected return in this point is larger than this point. So we don't need this part. We only find this part is effect. And maybe the best point is just in this part. So don't forget, we have a line of CAL, means how much do you have? And we can move the direction of the CAL, just the move. Because you can change the proportion. That means you can change the slope of this line. So just move. Until here, they have the crossing. They have you find the largest Sharpe ratio, because we like Sharpe ratio, right? Sharpe ratio, here means the expected return and here is the risk. So we like the large value of the Sharpe ratio. We prefer the large value. So large value means that you should just move the line and change the slope and get the best value, the largest value of the Sharpe ratio. So we find this is the best line. This is the best one, best point, okay? This is the best point. So this is the best point. Point P. And from this figure, we can connect chapter 2 to chapter 3. We can connect these two chapters just by this simple figure. If you want to determine how to allocate your capital, we have two steps. So this figure connects these two chapters. I think it's very clear. So first of all, what should we do? We should determine how to allocate your asset, your capital into the risky asset and the risk-free assets. How to determine? We use the indifference curve. We draw indifference curve, a series of indifference curve. But if you determine your risk aversion, you only have one indifference curve. In that case, don't forget, this is your how much do you have. This line is how much do you have. So in this case, we can find this optimal complete portfolio. That means we find the best points of the combination. Point C. After you get point C, maybe you have determined 80% should be given to risky assets and 20% should be the risk-free assets. In this case, how to allocate the 80% of my risky assets? Then move to point P. This means your possible assets, but this means your CL. CL means how much you have. So this is always should be controlled. This should be controlled. And we also find the best points, the optimal risk portfolio. So after you get the point C and the point P, all the steps has been finished. So it's easy to calculate. Point C and P. So you can get the optimal complete portfolio and optimal risky portfolio. So all the steps has been done. Then you can calculate how much maybe T-bills 25 and stocks bonds. Like first step you calculate this part and this part and determine how much should be put in the T-bills. That means risk-free assets. And after that, in risky assets, maybe you should determine how much I should put in the stocks and bonds. Okay. So I think this chapter is easy to understand. It's something like the extension of the chapter 2. So next we will move to another chapter about CAPM model. Okay, for this CP model, this is too famous. CP model is very famous. The capital asset pricing model, we call that CAPM. For this model, the person who proposed this model also win the Nobel Prize. So these are two famous. And in this chapter, we only introduce the simple one, But during this decade, many researchers have already extend this kind of CP model. Okay, so we will introduce the simple one in this chapter. CP model, how to say that? The final goal, the goal of the CP model is used to do the pricing stock. Is do the pricing of the stock. It's do the pricing of the stock. But if you just compare this model to the real stock markets, you can find that almost no relationship. Because stock market, the price of the stock is determined by many of the factors. I mean, the macro, microeconomic factors. So it's a little complicated to determine a real stock market price. But when they propose this type of model, maybe it's very ideal. It's very ideal because there are many hypotheses. And in the real stock market, these kind of hypotheses cannot be satisfied. So that's why we cannot use CP to do the pricing directly. It's almost impossible. So if everyone can use the CP model to do stock pricing, no one will lose money, right? We can predict we can predict the stock price accurately. So we can see that it's almost impossible. So it is a equilibrium model that underlies our model financial series. And Mark Sharp, this kind of person, are researchers credited with its development, and they win the Nobel Prize. And just now I said that it has some hypotheses or assumptions. If all of these are satisfied, then CP model is correct. But we can find that this is really not true in the real stock market. It's very difficult to satisfy it. So let's see that. Let's look at what are the assumptions. The first one, that means if the CP model is correct, it should have these kind of assumptions. The first one, investors optimize portfolios like Markowitz, like use the same model. Of course, we cannot use the same model to calculate stock price because Markowitz model, different person has different stock tracking, investing strategy, and also they have different holding period. In this case, actually, investors cannot use the same Markowitz model. And second one, investors use identical input list for inflation frontier. Okay, it's a difference with the text, a little difference with the textbook, a little difference. All investors plan for one identical holding period, but actually it's not true because different investors have different holding period. And third one, same risk-free rate, same CL and risky portfolio. We can see that it's also it's not true in the real market. Yesterday I said that if you and the government, you can compare the different interest rate. If you need a loan from the bank, so you can find that the interest rate between you and the government and the other businessman, other company, the interest rate for the loan is totally different. So in this case, we cannot hold the same risk-free rates. It's impossible in the real markets. Okay. So fourth one, market portfolio is an aggregation of all risky portfolio at same weights. We see that it's impossible because different investors, they have different risk aversion. That means the parameter big A, they have different risk aversion. In that case, they will not use the same strategies, and of course, they will not have the same portfolio. I mean, the proportion of the risk assets is totally different. So in this case, they cannot have the same weights. It's impossible. And also, maybe just now I just introduced 4 assumptions. Another is that all investors, they still have another assumption, which is all investors are rational, or investors are rational mean variance optimizers, meaning that they all use the market-weighted portfolio selection model. Actually, I think this is not true. If all the assumptions are satisfied, then what will happen? It will result equilibrium conditions. That means all investors will hold the same portfolio for risky assets. We call that market portfolio. But in the real world, in the real stock markets, we cannot apply the market portfolio. That means you should hold all the stocks, and the same portfolio for risky assets. And you should hold all the stocks, and for each stock, the proportion is their whole line, the capitalization, according to the capitalization. But it's impossible in the real world, in the real stock markets. So if you want to get a market portfolio, what can we do? We can use another thing to replace it. Which one? Index, right? Index. We can use index because index is the stock index includes all the stocks. So we always use, if you want to calculate in an easy way, we always use stock index. Replace the market portfolio, because in most of the case, they are almost the same. If you calculate the stock index, the result is almost the same with the ideal model. Okay, so the market portfolio contains all securities, and the proportion of each security is its market value. I mean the whole market value. Do you know how to calculate? The market value is calculated by the number of the stocks and its individual value, okay, as a percentage of total market value. So you can use the stock index, replace instead of the market proportion. Okay, we can see that risk premium on the market depends on the average risk aversion of all market participants. That means that if you want to do research about all the stock markets, first we should consider the index, the data from the index. Second one, it depends on the average risk aversion, because different person has different risk aversion. So if you want to analyze the whole stock market, you should calculate the average risk aversion first, and then you can calculate the risk premium for the whole market. Risk premium on individual security is a function of its covariance with the market. Just now I said that in the previous page, I just analyzed stock A and B. So you only calculate the relationship between stock A and B. But if there's stock A, B, C, D, E, you should calculate A, B, A, C, A, D, A, E, and B, C, B, D, B, E, like this. So that means you should calculate its covariance with the markets, with all the other stocks and also the markets. Then you can calculate the final risk premium for just the individual security. So we can find that just now we have already explained this line and this curve in the chapter 3, right? This is the best points. That means you can find the best trade-off. You can find the best trade-off in the efficient frontier. Efficient frontier is just in the upper side, because in the lower side, I just said that we will cut. We don't need that part. Okay. This is the equivalent about that. Okay, finally, we can calculate the market risk premium like this function. And this function is determined by the sigma. Sigma means the risk in the whole market, and also by the average value of the risk aversion. Okay, this means the average degree of the risk aversion for all the investors. So this is the difference between this function and the function for the individual. Just use the average degree of the risk aversion. Okay, so I will give you an example how to calculate G example. G example. G is a famous company in the world, right? So we will use a G example. If you want to calculate the stock price of the GE, so what can we do? We should calculate the expected return and the covariance of the GE at first. And then you can find a relationship between them and calculate the Sharpe ratio and get the slope of and also get the relationship between the two parameters. So first, you should calculate the covariance of G return with the market portfolio. I think this is easy to understand. Just use the function of covariance. Therefore, the reward to risk ratio for investment in G would be like this. This means you should calculate this based on the G's contribution to risk premium and the contribution to variance. That means if there are risks in all of the markets, actually this is a sum of the contribution of individual security. So that's why we need to calculate the contribution of each individual stocks. We need to find the contribution because they give the contribution both in the risk premium and the variance. They both give the contribution. So we should know the relationship between the contribution to risk premium, that means expected return, and also contribution to the variance. And find that it's like this. So finally, we can get the reward to risk ratio for investments in market portfolio, like this in the market portfolio, is determined by the market risk premium and the market variance. In that case, the ratio of G and the market portfolio should be equal to this one. And for the risk premium of GE, we can obtain these results from this function. I think this function is easy to understand, right? So finally, restating, we obtain the relationship between this is the expected return of GE. This is the risk-free interest rate. Okay, this is the interest rate, risk-free interest rate. And the beta means the relationship between the individual stock and the whole market. That means the parameters of sensitive. And this is the risk premium. This is the risk premium of the whole market. That means, of course, you should minus this one. If you just put your money in the bank, you don't need to do anything. In that case, you can still get the RF, risk-free rates. Risk-free interest rate. You can get the RF. So that's why we need to calculate the risk premium of this one, and this is the sensitivity of the individual stock to the market. So in this case, we can get this part of the extra expected return, and for this one, we can finally get the expected return of G. That means the G's expected return consists of two parts. The first one is RF. Second one is the expected return from the markets. Okay. this is you just put money in the bank, you can get, and this means you put your money in the stock market, you can get. So if you combine them, you can get the final value of the expected returns. And we can see that this is our CP model. This is the original CP model. It's easy to understand, right? This is the original CP model. And in the recent decades, people did a lot of extension of this model, because this model is very ideal. And I think that we have more than almost 5 assumptions. And these assumptions are very ideal, and they are not true in the real stock market. So in this case, this is CP model, but it cannot be applied to stock market effectively, okay? And expected return to beta relationship, we can find that CP model holds for the overall portfolio because they have this kind of relationship. And this also holds for the market portfolio. We can extend the previous function into the market portfolio. Just now, the function is used for the individual stock. But we see that we can easily extend it to the whole stock market, to the market portfolio. And also, you can extend the previous individual model for individual CP model to any combination of the portfolio, to any risky portfolio. That's true, no problem, okay? So if you draw a line, just between the relationship, just considering the relationship between the beta value and the expected return, we can get this line. This line, okay, big noise. So let's take a break. So every 1 hour we will take a break. Let's take a break first, and see you later, 10 minutes later, okay? See you later. 10 minutes. 15 minutes, okay? 15 minutes. Okay, let's have a break, take a break of 15 minutes, okay? Okay, let's continue the class. Just now we see that we have already obtained the relationship between the beta value and the expected return. So this is also very similar with the chapter 2. Like we still have the same straight line, but this line is not CAL. This line is SML. This line is SML. Almost all functions of the process are okay. About the question. Yes. Almost all assumptions of the basic CP model is because they are unrealistic, and this is totally different with the real stock market. So this is just a basic one, and the stock market pricing. The stock pricing is very difficult. It is affected by many of the factors, like in the macro, micro, in the macro and microeconomics. In this case, we cannot make the determine just by this kind of model. Yesterday I said that if you want to do stock trading, of course we have a lot of algorithms to predict the stock price, and of course you can just do it just according to the textbook. But the market is complicated, so this is just you can just refer to it. Sometimes you can refer to it and you can calculate the alpha, but it's true. You cannot use this directly. And later in the latter part of this chapter, maybe I will introduce some extension about the CP model. Of course, you can use the extension model of the CPM, and also you can use other asset pricing model. We have many different ways to do the stock pricing. Okay, so I will introduce later. You can use the extension of CPM, and also you can use other better algorithms. If the time is enough, maybe I can show you some algorithmic trading, strategy in my previous research, maybe several years ago. There is a big noise. There is a big noise in the classroom, so I hope you can hear clearly. Okay, let's continue. In the ideal model of CPM, but I just now want to say that even the model has a lot of problems, but the person who proposed this model, they win the Nobel Prize. So we can see that in some of the markets, this is very meaningful. This model is very meaningful. Based on that, most researchers have the chance to extend the CP model. So that means if the model is perfect, we can do nothing. We can do nothing about the extension. So I think it's something like the basement. Maybe the basic CP model is a very good basement. Then the latter researchers can do a lot of extension about the CP model. I think that is very meaningful. And in our research, because we are for the researchers, the most common situation is that one proposes a simple model and the other researchers can extend. So that's why we can publish papers. If the first one do a very perfect, perfect model, then we have nothing to do, just propose another model. So of course, it's not true in the academic field. So that's why every method has, especially because my in last 5 years, my research background is statistical method. So we always see that all the statistical methods are wrong. All the statistical methods are wrong if you change the assumption. Okay, if you change the assumption, all the methods are wrong. So that's why every model has its own assumptions. This is very important. Okay, let's continue. Well, after we get the relationship, we find this is very similar with the CAL, but it's not the CAL. This is SML. That means we can, if the price is correct, if the price of the stock is correct, it should be on the line. It should be on the line. Okay. So if the point is not on the line, that means we have the chance to get the profit. Something like the speculation. You will have the speculation. Okay. So we can see that if the stock is not on the line, like we can get maybe we can get alpha. Alpha can be positive or negative. It can be positive or negative. I mean, alpha means the gap between the real stock price and the stock price in the CP model. Okay, so it can be positive and negative. That means it can be overpriced or underpriced. Okay. We can see that actually this is a simple index model and the realized. Let's introduce something about the simple index model and the realized returns, because this index model is have a very strong relationship between the CP model. Actually, in the CP model, we only consider one kind of factor. That means the market portfolio. We only consider one factor. So let's say that if you want to determine to move from expected to realized returns, if we want to calculate the realized returns, not expected returns, use the index model in excess return form. So this is true, and this is very useful in the real stock markets. If you want to get the realized returns, you should calculate. Firstly, you should know the alpha. Alpha means the excess return. Okay. Alpha means the difference between just now I showed that between the ideal model, the CP model, and the real stock price. So we can calculate the alpha. And if you get parameters for beta, Rn, then you can find that the index model beta coefficient is the same as the beta of the CP model. And we can calculate, and this is more reliable. This is more reliable than the original CP model. Okay, this is the index, single index model. And for the assumptions of the CPM, we see that for the just now we see that it's a very ideal model, and there are many assumptions. Like for the individuals, it should be mean variance optimizers. Everyone should believe the mean variance is the best choice, but actually maybe it's not true. Homogeneous expectation, and all assets are publicly traded, can be publicly traded. Actually, we know that not all the assets can be publicly traded. Sometimes they are traded in another place, another way, in other place and way. So this cannot be considered here. And sometimes like the human resource, you know, for the, it's also like the salary. It is also one important factor. But in this model, we didn't consider like the salary for the human resource. Okay. And for the markets, all assets are publicly held and all information is available. Of course, this is not true. Who can guarantee all information is available? Because people working in different field, they can get different information. Of course, the manager of the fund can get more information than you, because they have the other ways and you don't have this kind of way. Of course, insider trade is illegal. Okay, insider trade is illegal, but we cannot say that everyone can get the same information. Of course, it's impossible. And also for the market, no taxes, no transaction costs. These are very ideal because impossible, no taxes and no transaction cost. Actually, for the transactions in the options and the futures, transaction costs is very important because sometimes when you calculate in the most common situation, in the most common case, you should calculate the payoff first, your payoff first. Then the payoff should minus your cost. Then finally, you can calculate your profits. So that means the profit is determined by the payoff and the cost. We cannot ignore the transaction cost. Sometimes if your transaction cost is too high, maybe your profit is negative. So in that case, that's very, very bad strategy. Okay. So most of the many researchers have already do the extension of the CP model. We can add some factor because the original CPM is very ideal. In this case, we can consider more factors into the model. Like first one, zero beta model, help to explain positive alphas on low beta stocks and negative alphas on high beta stocks. That means it extend the meaning of beta. Not only the sensitive of the individual stock to the market portfolio, but more meaning about zero beta. So that means extension about the beta concept. This is the first kind of extension. Second one is consideration of labor income and non-traded assets. Just now I said that for the CP model, all the assets should be publicly traded. But we can also consider long-traded assets in the markets, and we can change the model. And of course, the labor income, just as I said that they don't consider the salary for the human being. There's no salary. They don't consider salary. So of course, you can consider the labor income into this model and consider it as a very important parameter. Okay. And for Merton's multi-period model and held portfolio. In the original CP model, it supposed that everyone has the same investment period. Of course, it's not true. For example, for the European option and American option, we know for the option, there are American option and European option. In this case, they have different holding period. For the European option, you must hold your option until the last day, and you cannot do the trading before that. But for the American option, you can hold. It's very flexible, and you can trade. You can trade anytime. You can trade at any time just before the last day. So in this case, they're totally different. We can see that for people buy the European option and the American option, we cannot use the same pricing model. So who can see that people will do the investment in the same period? Okay, this is just one example. So in this case, to solve this problem, you can just use the multi-period model instead of the single period model. So that is one of the extension of the original CPM. And of course, you can incorporation of the effects of changes in the real estate of interest, and like other investors can also allocate wealth between consumption today and investors for the future. By this one, we can use this model to this kind of things. And also, you can consider the liquidity. Just now I said there are difference. There is difference between the European option and the American option. That means they have different liquidities. The trading time is one is flexible and one is fixed. So that means they have different liquidities, and the liquidity will give you liquidity premium. It can give you the liquidity premium. That means discounts from fair market value must accept option quick sale. Quick sale is very important. In China we can buy the we can do the shopping. We can do the online shopping. Just Jingdong, Taobao, right? But people in China they like Jingdong because they have a quick sale. That means there are many. If you have an order, if you give an order today, you can receive tonight or just in the morning tomorrow. Just in the morning tomorrow. So it's very quick. Jingdong can do that, but in Taobao, maybe 2 or 3 days you can receive your product. So that's why we say that liquidity will give you premium. Now that's why people like do the I like Jingdong. I don't like Taobao because the time is very important for us. If you give an order, of course you want to receive the you want to receive the clothes, something like the clothes immediately. We cannot wait. So the liquidity is very important. Because it's important, so it will give you the premium. That means it will give you some extra value of that. So, okay. Measured partially by bid-ask spread. Okay, as trader costs are high, the liquidity discount will be greater. Okay, because it will give you some extra premium. We can understand this. This is about liquidity risk. This is not important. We will not explain every page of this. Academic world, we know that CPU and world, and this give you some. Just now we say that for the academic world and the practice world, it's totally different. Yesterday I said that we know all the theories in the financial markets, but we don't want to do stock trading because we don't have time, we don't have enough information. Maybe the manager of the funds, they have more information than us. We only get the information from the news and or from the book, but it's not enough. The real world is complicated. So we can see that for the academic world, cannot observe all tradable assets. Impossible to pin down market portfolio, and we have a lot of assumptions. So that's very difficult to apply to the real world. And so for the investment industry, we can say that sometimes we use different single index CP model, and we also use the extension of CP model instead of the original one. Most investors don't base the index portfolio. If you don't like the risk, maybe you can do some investment just for the index, because you can always get the average profit of that. Let's look at the exercise. Some exercise. I say that if you want to pass the level 1 of CFA, the level 1 test of CFA, these kind of exercise are very important. You should do that. But in the CFA level 1 in the test, it's not like this. You don't need to write down. You don't need to write down the steps. Just choose A, B, C, D. You just need to calculate the final result. Okay. So I'll give you 2 minutes to read this question. Okay, consider the following table. We can see that for market returns, we know the data of the market returns. And there are two kinds of stock. One is aggressive stock, one is defensive stock. Okay, they have different, the investor has different risk aversion. So that's why there is aggressive and defensive. What are the betas of two stocks? First one, second one, you need to calculate what is the expected rate of return. And third one is draw the SML, draw the line based on the data. And finally, plot the two securities on the SML graph. If you want to calculate the beta of the two stocks, I think we have an easy way. You don't need to use the parameters. You don't need to, in some of the case, you don't need to use the ZO directly to calculate the beta, because the meaning of beta is that the sensitive of the individual stock price with the market portfolio, with the price of market portfolio. In this case, if you want to calculate the beta, you just calculate based on the number in this table. Is enough. Okay, let's look at it. For stock A and D, we compute each stock's beta by calculating the difference in its return across the two scenarios divided by the difference in the market returns, because we have already get this data in the table. So it's easy to calculate beta A and D. The change, okay, the difference of the individual markets and the whole individual stock and the whole stock markets. Okay, so it's easy to calculate beta A and beta D. With the two scenarios equally likely, because both of them have the 50% scenarios. All of them has each of them has the 50%. 50%. So the expected return is the average of the two possible outcomes. So it's easy to calculate. And third one, you should draw a line about SML. You can draw a line about the SML, and by this one, you can see that we can find the points of the A and D. The points of A and D, they are not just on the line. So they have a gap between the real stock price and the SML. That means the ideal stock price. And so we can calculate the alpha for stock A and D. We can calculate the alpha. So this is a way to calculate the alpha. The aggressive stock has a requirement, has a required expected return, required. First, you calculate the required expected return, 24%. And after that, you can calculate the alpha A, because we have already calculated the beta. This one, we have already calculated the expected return is the average of the two possible outcomes. We have already get the ideal model. This is the real stock market. This is the expected return in the real stock market. We get the data from the table, and this is the data from the CP model. So we can calculate by the actual expected return and the required return. So the alpha is negative. We don't like negative alpha. We like positive alpha, right? Everyone like positive alpha. Positive alpha means that you can get the profits. You can get the profits. And that means your profit is just better than the index. It's better than the market portfolio. You can get the extra profit. extra in return. So everyone like the positive alpha. The larger, the better. The larger, the better. And we don't like the positive. We don't like the negative alpha. Okay. So we can get the alpha, and similarly, the required return for the defensive stock can be calculated by ERD, and we can also calculate the alpha 0.3, 0.3. Bond price and yields. Maybe before I introduce the next part, the bond price and yield, I will find an interesting PPT and show you. That's my research. Maybe several years ago, I proposed a trading algorithm. Okay, I proposed a trading algorithm, and this is very interesting. We apply it to stock markets and get a very good result. So maybe I will find the PPT. Before I introduce the bond price, I think if I continue to introduce the stock price, bond price, it's a little boring. And all of this about calculation. So I will show you a very interesting research because I did this maybe several years ago when I was working in Shanghai University of Finance and Economics. From last 10 years, I have been working in Shanghai University of Finance and Economics. So from 2020 until now, I'm working in Hunan University. So I changed the university. Okay. Why? Oh, that's a complicated, story. I think because the developed chance is different. You know, in Shanghai, there is very competitive. There are a lot of I think because of the environment, and it's the most important factor. And actually, my major is information science. My doctorate degree is from the engineering field. So actual background is computer science. But I was working in Shanghai University of Finance and Economics, the college in statistics. I'm working in statistics. It's totally different with my major. So I didn't feel very, yes. I don't like that kind of research, actually, but I must do because I have a lot of master students, doctor students. If I didn't do research about statistical method, they cannot graduate. So I must do this kind of research that I don't like. So 3 years ago, I have a chance to be here, and this is a business school. I like business school because in business school you can do a lot diversified. The research field is diversified. You can do information science, computer science, and management science, operations research, financial engineering. Anything is okay in business school. So I like this kind of environment. Of course, the salary is higher than maybe it's like in Shanghai. Salary is also important, right? So I did this maybe several years ago in Shanghai University of Finance and Economics, and I think it's very interesting. And my doctor candidates, I didn't use that. but I just use this for paper writing, for writing paper, okay? But my doctor candidate apply this model to the real stock market, and he told me that gets a lot of money, gets the very good profit by this model. So I think it's very interesting, and I would like to share with you. It's about my own research. And I just said that yesterday I told you that we have a lot of trading algorithms. This is one kind of trading algorithm. And originally, this idea is from the machine learning, from the AI, artificial intelligence, machine learning. My basic concept is from this. So it's about study on stock trading and portfolio optimization using evolutionary computation. Evolutionary computation is a very important branch in the AI algorithm. Okay, it's just one very small branch of that. And based on the evolutionary computation, you can do the optimization in in many fields, not only in the financial markets, but you can also use other control method, other control fields. Okay. First, I would like to introduce the background of the evolutionary computation. Just now I said that actually it's a branch of the AI, and we can also say it's very similar with the current machine learning method because all of them can be used for the optimization. Okay, so we call that EC. EC is well known for producing the solution in optimization problems based on change, composition, and selections. It has these kind of advantages. First one is adaptability. EC does not have much mathematical requirements about the optimization programs due to the evolutionary nature. For the traditional, just as I said, I don't like statistical model, I don't like mathematical model because they have a lot of requirements, a lot of assumptions, a lot of requirements. Then you can solve that. But I don't like this kind of things. But in EC, it can be used. It can be used. They don't have mathematical requirements, but it can be effectively used to solve this kind of optimization problems. That's why I use that. This is first advantage. The second one is about the robustness. The use of evolutionary operators make EC very effective in performing global search, while most of the conventional heuristics usually perform local search. What is global search and local search? In the last chapter, I said that if you want to find the best allocation of the capital, you should find the highest points, or you should find the crossing points of the curve and the line. But in EC, we see that in most of the case, maybe the best point is local search because AI will search the best solution just in a very big world. In the big field, we can find the best one. But if this one is just a local search, we cannot say it's effective. So if it can do the global search, that's very good. Maybe it can get the optimal points in a very short time, quickly find. The last one, flexibility, is very interesting. It can be compliant to many methods in the AI field. It can be combined with many methods. So EC provides a great flexibility to hybridize with heuristics to make an efficient way to find the best solution. So this is the advantage of EC. So that's why I used the EC to do the stock trading. We call that the algorithmic. You can also say it is the algorithmic trading. Okay. And I will show you the algorithm, how to use the computer to do the stock trading. That means how to propose the algorithm to do the stock trading automatically. First, let's have a look at about this algorithm. This algorithm is originally proposed by my supervisor. when I was in Japan, my supervisor, he's a Japanese, and he proposed the genetic network programming. Maybe this belong to the computer science field, of course, programming. So belongs to the computer science field, and he proposed this method 15 years ago. 15 years ago, and this is originally applied to the elevator control, and the GPS. We use the for the navigation. Okay. Firstly, GMP is only used in two fields. One is navigation. We use the GPS, and another one is for elevator, double deck elevator control. But I firstly use it in the financial markets and use it for stock trading. Okay, so that's my first time is applied to the stock trading is by me. Okay, it's by me. And why my supervisor, Professor Hirasawa, why he proposed this kind of method? Because in the AI, in this branch, in the heuristic, in the EC branch, in AI field, actually GA is proposed artist, maybe in the artist here, GA proposed. But based on GA, people proposed this genetic programming is something like an extension of GA. And after that, GP is proposed based on the GA and GP. Let's look at about this table, about this figure. Okay, GA means 1010. It's like this. Very original from the computer language. Okay, and for GP, it's like a figure. But in GP, there is some disadvantage. If the portfolio is very big, then this node and edge will be something like bloating. It has a problem of bloating, very big tree. In that case, we cannot calculate and we cannot get the good results in a short time, very quickly. We cannot do that. So my supervisor, maybe he considered that why not just combine these two methods, like just combine the GA and GP. So he proposed this kind of method. This figure has the judgment node, precision node. This means judgment node. This means precision node. They have the directrix edges, and by this one, if you just put the data into this model, just input the data in the model, the output is for your trading suggestions, trading action, buy or sell, something like this. So it's very useful. And this one is another extension, and I don't want to explain GRA in this class. Just introduce a GMP and okay. And also, just now I said that GMP is very good method, and it can be applied to the stock market for stock trading, and also it can be combined with reinforcement learning. Do you know reinforcement learning? Reinforcement learning, RL. Oh, that's very famous algorithm in the machine learning. You should know the typical methods. You should know. I think you should know the typical method in the current days. You should know the typical methods in the machine learning field because it affects your life every day. Okay. So RL is a very famous, very typical famous method in the machine learning field. Okay. So in this research, I just combined the GMP with RL with reinforcement learning. Why I did that? Because I can combine advantages. When you are doing the academic paper, maybe you can do this kind of combination, and maybe you can do a new research. It's very easy to understand. Evolution, many individuals work and better ones are selected after task expansion. That means for evolution, it's a diversified search. That's a diversified search. That means if they are doing the stock trading, after 3 o'clock, like in China, after 3 o'clock, all the tradings are stopped. After 3 o'clock, all the tradings are stopped. In this case, we see that it's a diversified search, okay? Because you cannot change your trading strategy during the daytime. You can only change your strategy after 3 o'clock in China, in that case. So we see that it's a diversified search, but it's an offline learning. Every day after that time, you can change your strategy. That means offline learning. But if I combine my original GMP and the reinforcement learning, I can change it from offline learning to online learning. That means one individual works and learn action rules during task execution. You can change your strategy just during your transactions, during your trading actions. That's easy to change. So that's why I want to combine the advantage, combine it because I can get the advantage of the offline learning and the online learning in the same time. And also I can combine the advantage of diversified search and intensified search. Because if you want to get the best solution, the best point for the portfolio allocation, if you want to get the best points quickly, you must do the diversified search and intensified search in the same time. Diversified means a lot of points, but intensified means just very deep, and you can find it quickly. So search for better solutions and improve the search speed. So that's the background why I want to combine these two methods. And this figure very interesting. Very interesting. I show you what is the evolutionary process of GMP. That means for the you can consider it as an AI algorithm, like an AI algorithm. In this case, what can we do? Why GMP can be used to do the stock trading? Let's look at the evolutionary process of GMP. For example, there are several individuals like GMP 1, 2, 3. There are different individuals, and in every individuals, in the brain of every individuals, you can consider this as something in the brain of the individuals. 1, 2, 3. This is the GMP basic model. It consists of two kinds of nodes and directed edges. Okay, so this is the GMP model. And based on the GMP model, by using the genetic operators, the generation. In this case, I want to show that you cannot only consider the individual. It's like the human being. The quality of generation is increasing, right? The quality of the human being. If you just consider the generation, it's increasing, it's improving, right? Every day. If you consider the human being today, the previous ones. So the quality of generation is increasing, is improving. In this case, we cannot only consider the individual, we should consider the whole generations. If the whole generation is improving, that means your algorithm is effective. So you can consider it like human beings, or like the person who are doing the stock trading for you. 1, 2, 3, person 1, 2, 3, like this. Okay, so based on the genetic operators, generation 2 is better than generation 1. And what is genetic operators? It includes crossover, mutation, elite selection. Okay, 3 kinds: crossover, mutation, and elite selection. By this kind of genetic operators, generation 2 is much better than generation 1. We can control that. We can control the whole process. So after that, finally, we can get the best generation. How can we say it is the best generation? Because they have the fitness function, right? It has a fitness function. If the fitness function curve get a convergence, like increase, converge. then stop. The training should be stopped, okay? Because you cannot improve anymore. So if it converge in a stable level, then stop. The training should be stopped. It's something like training and testing. Do you understand? For the whole process of the GMP, it has two stages. One stage is for training. The second stage is testing. If you want to have a robot, first the robot is not so clever as you expected, right? So you should use training. You should do the training to make the robots more clever. So this is something like the training stage. Makes the robots, make the individual 1, 2, 3 more clever. So after that, you get to the cleverest. You get the cleverest robot, the cleverest individual, and then you move to the testing stage. That means you can use this robot to do the stock trading just by itself. In this stage, it's not by yourself. It's by you. It's by you. You will do the trading, right? So after that, when it is clever enough, you can just use the individual to do stock trading by itself. So that's why we need to divide it into trading stage and the testing stage. Okay, two stage. Very interesting. So after that, you get the best individual. That means in the brain of the best individual, we get the best GMP. We get the best GMP structure. Okay. And so I show the logic relationship between we use GMP and self-learning. Self-learning is reinforcement. It's the same with reinforcement learning. It's one of the typical methods in the reinforcement learning. Okay, so we use GMP and self-learning. And finally, we want to design a stock trading model. We want to propose the GMP, the stock trading model, to do the buy and sell action. And also, this is the basic structure of GMP and reinforcement learning. We can see that there are different judgment node, precision node in this figure. And for judgment node, that means each node judges the information in an environment. If you want to ask an individual, if you want to ask a robot to do stock trading, of course, you should input the information from the outside environment, right? You should input it into a robot. Then it can do the algorithmic automatic trading. That's why we need judgment node, because judgment node can get all the information from the outside world. Okay, like ROC, RSI, MACD, all the information, it can be the input in this model. And for the processing node, it is used for the action, is for the buying and selling action. If we move to the buying processing node, it will buy or no action. If we move to the selling processing node, it will sell or no action. Okay, so it will determine whether take buying action or selling action. This is the role of the processing node. And don't forget, I said that I combine reinforcement learning and GMP. I combine these two parts. And this is the role of evolution and learning. In this case, we can see that if you consider this state, we have the parameters of state and action. And the state means the current node, judgment node or processing node. Action means it will select a subnodes for taking actions. Okay, and this is the node structure. Each node has two subnodes, and it will determine the transition way based on the ROC, RSI, and the Q value. That means if the Q value is larger, then we will move to this way. So it will automatically complete in this model. And we also use the MACD as a judgment node information. We can also get the information from the judgment from the MACD. And we find that since there are too many kinds of technical indexes in the stock market and different index has different calculating method, it's difficult to compare with each other. So that's why we proposed the IMX importance index to put different calculation is used for putting different calculation methods into the same model. That will be fair. That would be very fair. Okay, so just put this. This means the value of the RSI. That means if the value, suppose the value is 0.2, we can get two kinds of results. The first one is that we know next stage we should choose brand A. The robot should choose brand A because 0.2 A. So in A, so it should choose this brand. Okay, with this result. And after for this 0.8, so we keep this value, and this value will be used later for stock trading. And just show you, this is a low transaction in the robots. They have subnode and they have no transaction. And all the branches selected according to the reward. What is reward? For different situations, the meaning of the reward is different, right? For the GPS, for the navigation, maybe the reward is that you save the time, you save the distance, right? You save the time and distance, and the computer gave you a very good this mobile phone, this Baidu, like a Baidu. The GPS software give you a very good optimal route from your home to company, right? So that is a reward. You save the time, you save the distance. We like that. But in the stock market, reward means expected return. We like expected return. We don't like risk, right? So maybe reward it can be set as expected return. I think it's no problem. And of course, you can also consider the risk factors into your model. And finally, from the previous processing node to the current processing node, there are many judgment nodes inside previous processing node. That is buy or sell stock. When you buy or sell stock, then you move to the next stage and judge the information. It's something like a circle, right? Buy or sell stock and then judge information, then buy or sell stock, judge information and buy or sell stock. It's like a circle. Okay. And after getting this information, you can calculate the output of these four judgment nodes. That means the role of these judgment nodes is to get information from the all the stock market for the environment. So after that, we can get the 0.45. So in the current processing node, when in the case of buying processing node, if the robot move to the buying processing node, if the A is larger than the threshold, then the robot will buy stock. If less than that, then take no action. So in other case, in the case of selling processing node, if larger than the threshold, take no action, and if less than threshold, then sell. So we can say that this is a processing function of the judgment node and the processing node. And also in this research, we use the candlestick chart. This is also very typical, right? We use the information from the candlestick chart and put this information into judgment node, and it will help us determine when should I buy or sell. Okay. And of course, if you get information from one stock, you can judge which kind of thing, which kind of shapes. So we can divide into two kind of types according to some criteria. First one is judge whether or not there is a window between yesterday's price and the day before yesterday's price. Then it can be judged into four kinds. And judge whether or not yesterday's closing price is higher than the day before yesterday's opening price. Then another four types. So totally 8 types. If you get information from the outside environment, you can choose maybe brown C. Okay, so this is for chart. this is a flow chart for this algorithmic trading. First one is the learning phase. In the learning phase, okay, you should do the training. You should finish the training part, and after that, you can do the reproduction by evolutionary. In the evolutionary phase, you can do the reproduction by crossover, mutation, and elite selection. Crossover is finished by two individuals, right? That means two individuals will communicate with some knowledge, and mutation can be finished just by one individual. But elite selection means that the best individual in the previous generation will be kept directly or move to the next generation. That means elite selection. Okay, so finally we will use this for the trading. Trading means testing. So first training, after that testing. And of course, in the learning phase, for the reinforcement learning, this should be calculated. This could be updated. The Q value should be updated because this is the online learning process. Online learning means that when you finish your task, maybe you are correct, maybe you are wrong. If your prediction is correct, then the reward will be positive. The reward of your action, if you do action like buy stock of IBM, sell stock of Apple, in that case, if your action is correct, you can get a positive reward, and this will be kept. If your prediction, your expectation is wrong, your strategy is wrong, then you can get a negative reward. So every action you can get a negative or positive reward. That means you can change your strategy immediately. So that's why we call that this online learning method. And of course, the Q value can be updated every second. So that's very effective because it's an online learning method. Okay. Don't forget there are four kinds of important parameters. S means state, means current node, judgment or processing, buying or selling, the judgment node, the current node. Action means select a sub-nodes. How to select a sub-nodes? And alpha means the step size parameters. And the gamma means the discount rate. How to understand the step size parameter in reinforcement learning? I will give you an example. Like you are you lost the way. You are lost in the forest. You don't know how to leave the forest and find your right way, right? So you can only the only choice is to just try in different directions, right? You just try in different directions, south, north, east, west, in different directions. So some people has different risk aversion, right? So maybe you want to try 1 kilometer. I just want to try 0.5 kilometer. So that means we have different risk aversion. In this case, your step size parameter is different. You're 1 kilometer and I just want to try 500 meters because yes, I'm a little worried about that. So just every direction and 0.5 kilometers. So this can be maybe it's easy for you to understand what is step size parameters. Okay. And just to show you how to do the crossover. Okay. Crossover means individual A and 2, individual 1 and 2. They will change the whole structure, like the nodes and the edges. They will be changed because this should be diversified. Okay. And for mutation, this means that they can change the connection, change the node parameter, and also change the this randomly. Also change the subnode functions randomly. Okay, and of course we did the simulation. We did the simulation for 4 years, like 3 years for training and 1 year for testing. So that's why I said that my dot candidates apply this to stock markets. But I think this why I never use, because this is very ideal model, because reward is selling price minus purchase price. Actually, you cannot just use this one. You cannot just reward to you cannot how to say that, you cannot construct your fitness function just use the reward, because selling price minus purchase price is very simple. It didn't consider the important factors for risk management, right? There risk. You cannot only consider your profits. You should also consider the risk simultaneously. Because if you get profit every day, like 1 month, for example, if you get the profit continually for 30 days, continue to get the profit in the recent 30 days, but you can lose all the profit just in 1 day, right? So the risk management, the risk control is very important. So in this model, it's very interesting, but the shortage is that we didn't consider this kind of risk factors, okay? So after that, we divide it into 3 periods and use this kind of technical indexes. And then this is a simulation conditions for the reinforcement learning and EC. And we can compare different companies, and we find that the GMP reinforcement learning can get more profits than the GMP and the buy and hold. Okay. And this is the Phoenix curve in the training period. We can find that it is keeping increasing. That means your model is effective. But if it converge, and if it gets a convergence like this training should be stopped. This be stopped. Maybe 300 generations is enough. You don't need to trade it. You don't need to trade it for 500 generations. It will cost more time, but it will not be more effective. So I think convergence, if it gets a convergence, then it's enough. You can stop the training. Okay, and for this we can see the buying point and the selling point for the robots. Okay, black one buying point. This is selling point. We can see every time it can buy in a lower price and sell in a higher price. We cannot see in the lowest price and the highest price. No one can do that, right? So if he can buy in a lower price, sell in a higher price, that's almost perfect. No one can predict this point, but this point to this point, I think is a very good pair. Every time it can get the profit, and we get very good result. In the paper, we get very good results. And when my student applied to the real stock market, he told me that very good profits. Okay, so I just share you about that. But after this, we also, of course, we did a lot of extensions about this research. But if you are interested, maybe you can read some paper online. We have a lot of papers of GMP online. We published maybe more than 10 papers of GMP. So if you are interested, you can search this kind of papers or the similar algorithm, because it's not only reinforcement learning, it's not only SASA learning and GMP. We can also use reinforcement learning dependently to do stock trading. And also you can use the neural network to do the prediction. You can use SVM, support vector machine, SVM, to do the prediction and the stock trading. A lot of choices. A lot of machine learning methods can be used for the stock trading and risk management. Okay, so I just give you a little part about this one. And I think it's very interesting. And if you are interested on this kind of algorithmic trading, you can refer to other papers. Okay. So let's take a break. And we will have the last class. Okay. About question, I cannot share my paper. You can search for GMP. There are a lot of papers. Just the keywords: genetic network programming. Okay, GMP. You can find more than 10 papers. Okay. So maybe we can have a rest around 10 minutes. Okay, see you later. Okay, in the last lecture, we will talk about the bond prices and the yields. Bond pricing and yields. After we get the information from the stock market and how to do how to allocate the capital into risky assets. After that, we will move to another market, not stock markets, bond markets. So this chapter is about bond prices and the yields and a lot of calculation. Actually, in this chapter is a lot of calculation. And first about chapter review. In the fixed income markets, we should know the types of bonds. And after that, we should know the bond pricing, including how to calculate the prices and the yield, the prices over time. And finally, we will introduce the impact of the default and credit risk on bond pricing. In this case, we will introduce the credit default swaps and CDS. Okay, we will introduce CDS and other debt obligations. But the most we will most focus on the first part, the bond pricing. Okay, for the bond characteristic, because this market is totally different with stock markets. We can see that in the stock market, it is in a high risk. We are always in a high risk. But in the bonds, in the fixed income markets, the risk is very small. And also, we should divide the bond market into short-term and long-term. Actually, short-term bonds almost no risk, but long-term bonds sometimes a little risk. But if you buy the government's bonds, even it is long-term, almost no risk, because in China the government will not go into bankruptcy, but in USA maybe government will also go into bankruptcy. Okay, and also the same things happen in the bank. In China, the bank will not go into bankruptcy because government will have a lot of will protect. Okay, government will protect because it's national. So almost in the bond market, almost no risk. Bonds are debt obligations of of borrowers to creditors. And for the bonds, we know there are a lot of important characteristics, like the face value. Sometimes we call that per value, and we also call that face value. For example, 100 or 1,000. The face value always be this kind of these two types, 100 or 1,000. This is face value. And also, if you want to buy a bond, you should know the face value and the maturity, their maturity. How long is the bond? 10 years or 20 years, the maturity time. About that maturity about this one, about this bond. And finally, you should know the coupon rate. This is there are three important characteristics for one bond. The coupon rates mean that every half a year or every 1 year or every year, at the end of every year or every half a year, you could receive something about something from the interest rate. We call that coupon rate. You will receive the coupon rate. In most of the case, it is paid semi-annually. In half a year, you will receive a coupon rate. So after you get the information from the coupon rate, face value, and the maturity, then you can determine whether to buy this one or not, or you can determine whether it is attractive enough. In U.S. for U.S. Treasury bonds and notes may be purchased directly from the Treasury, and the difference between the note and bonds are the time, 1 to 10 years, 10 to 30 years, long term or short term. And first, I'd like to introduce the types of the bonds. The types of the bonds. The first one is callable bonds. There's government bonds and corporate bonds. There are 4 types of the corporate bonds. The typical types. The first one is callable bonds. Callable bonds mean that it can be repurchased before the maturity date. How to understand this one? That means if the interest rate in the bank, suppose that the interest rate in the bank is 2%. Suppose that the interest rate in the bank is 2%. If the company wants to issue the bonds, and if the company wants to attract you to buy the bonds, the interest rate, of course, should be higher than the bank, right? So if the bank is 2%, maybe the company will will offer a 3%, will offer a interest rate of 3%. In this case, maybe you will choose to buy the corporate bonds, not from the bank. But maybe after 1 year, the interest rate in the bank is decreasing. Maybe it's just 1%. In this case, the coupon rate in the company will also decrease. So maybe the company is a little regret about that. Last year is 3%, but today the interest rate in the bank is decreasing. So I want to decrease the interest rate, the coupon rate. In that case, this kind of bonds can be repurchased before the maturity date. Okay, it can be repurchased before maturity date and issue again in a lower interest rate, in a lower coupon rate. That means the coupon rate of the corporate bonds is based on the interest rate in the bank. So if the interest in the bank is changing, this will also change. If increasing, then increasing, decreasing, then this decreasing. So that's why the company will repurchase before the maturity date to avoid the risk. Second one is convertible bonds. Convertible bonds means one company maybe issue the bonds and the stock in the same time. Like IBM issue the stocks and the bond in the same time. But if the outside environment, if the current environment is very good, then I prefer holding stocks. I prefer holding securities, not bonds, right? But if the outside environment is very bad, then I prefer holding bonds, not stocks. So if the IBM has both the bonds and stocks, it allowed you to change the bonds to stocks or change stocks to bonds flexibly. Okay, so this means convertible bonds. You can change, but you cannot just convert the bonds to stocks. How to say that? There is some limitation. You cannot do that at any time. There is some limitation, especially in Chinese markets. If you want to change the stock into bonds, there is one limitation. The limitation is that when you do the conversion, when you change, you cannot get a profit. That means the value should be decreasing. the value should be decreasing. If you change your stock to bonds, that means the current value of bonds, when you compare the current, when you change stock to bonds, the current value of bonds should be less than the stocks. That means you will lose a little money. In this case, IBM allow you to do this kind of change. Otherwise, you cannot change and get the profits. But it doesn't matter. People will do that because they have different expectation. Even today decreasing, but I predict tomorrow, 2 days later, increasing. So that's why I have the original. I have the power. I have the expectation. This kind of expectation to do that. And we also have there are also another two kinds of the corporate bonds, like puttable bonds and floating rate bonds. You can understand this just by the concept. Puttable bonds means giving the holders an option to retire or extend the bonds, and the floating rate means that you have adjustable coupon rate. So it's very flexible for the next two, for the last two kinds. So this is the two types of the corporate bonds. And there is a very typical, very special preferred stock, because preferred stock is something like both the stocks, normal stock, and the bonds. Preferred stock has both the characteristics of equity, of equity and fixed income. Okay, shares characteristics of equity and fixed income. Dividends are paid in perpetuity. In this case, this character is like the bonds. It's something like the bonds. No payment of dividend does not mean bankruptcy, and preferred dividend are paid before comma, no tax break. In this case, it shares the characteristics of both the equity and fixed income. Okay, this is the preferred stock. And for the innovation in the bond market, in the bond market, we can see that there are different kinds, like inverse floater, acid broker bonds, many kind of different bonds and different bonds. And I will not introduce this in the classroom, in this class. And if you are interested, you can refer to the textbook by yourself. Okay. And for this one, this is bond pricing model. Okay, for the bond pricing model, I just directly give you this model how to calculate the bond price. Actually, it consists of two parts. P means price of the bond, and C means interest or coupon payments. C means interest or coupon payments. T means number of periods to maturity, number of periods. R means semi-annual discount rate or semi-annual yield to maturity. We always call that YTM. YTM means yield to maturity. In this case, the price of the bonds consists of two parts. First one is about the coupon rate, the current PV value, present value of the in the financial markets. If you want to do the minus or add, in this case, all the numbers should be in the same time, should be in the the same level of time. In the time series, it should be in the same level of time. So first one, we should calculate the PV value of the cash flow. PV value of the cash flow of the coupon rate. So PV value means present value. Everything should change to the present value. Then they can just calculate together. Okay, so first one is about the cash flow of the coupon rates, cash flows of the coupon rates, and the second one is the face value. We should calculate the current value, the present value of the face value. So this is all the cash flows in the future. If you have a bond, there are two parts of cash flows. First part is your coupon rates. Every half a year, semi-annually coupon rates. Every year you can receive 2 times for the coupon rates. So you must calculate the present value of the cash flow coupon rates. C is coupon rates. Okay, and finally, if your holding period is 3 years, if the maturity of this bond is 3 years, that means at the end of third year you can receive the face value. Then you calculate the present value of the face value. You receive this every year twice, and you receive this at the end of your investment, at the end of your holding period. Okay, so we calculate the present value of all these of these two parts, and finally we can get the price of the bond. So I think this, for example, I just put the figure into the model. Just put the figure in the model. Use the figure price of 30 years and 80% coupon bonds, and we can calculate. Just use the formula. But don't forget, this T means the holding the total period. 30 years. But this is paid twice 1 year. So in this case, T means 1 to 30. Because it is they have the 30 periods. And actually, I will introduce one more concept about that. Interest rate, YTM. This is about the YTM, yield to maturity. Actually, in the previous one, every year actually we have different interest rates. We have different interest rates every year. In this case, actually the small r is different. Here, the small r is different in different years, but it's a little complicated if you use different interest rates every year. So we need to use yield to maturity instead of different r in every year. It's something like the average value. Yield to maturity is something like the average. Value. So in this case, we use this instead of the interest rate every year. See face value. And this is another exercise. YTM, how to calculate YTM? How to calculate the YTM? YTM means average value, average yield during the holding period. Okay, so suppose 8% coupon 30 years bond is selling for 1,020. What is its average rate of return? What is average return of return? And just use this kind of figure, and I think this is very important. This is very easy to solve. And this will show you price over time of 30 years maturity. And bond price approaches face value as maturity approaches. Bond price. Bond price approaches face value as maturity approaches. Every one, no matter you bought this more than face value or less than face value. Of course, when you hold the bonds, you can buy it in different prices, sometimes lower than the face value, sometimes higher than the face value. This is determined by the attraction. So everyone has different choices. After that, no matter what happens, finally it will reach the same value. This value is face value. And you should know the difference. Next, you should know the difference between YTM and holding period return. Okay, for the YTM, it is the average return if the bond is held to maturity. Depends on coupon rate, maturities, and face value, but holding period return is different with YTM. YTM is something like the average return if the bond is held to maturity. But HPR is the rate of return over a particular investment period. You only need to the initial value, final value, then you can calculate the HPR. But if you know the initial value, final value, maybe you cannot calculate the YTM directly. And also, this can be default risk and bond pricing. The risk of the bond can be determined by several factors. The default risk can be determined by several factors. And coverage ratios, leverage ratios, like the liquidity ratios, this is important ratios in accounting. And several years ago, in a very earlier age, they use this kind of things to judge whether this bond has a default risk or not. So this is the early proposed method, and from this one we can see that by the parameters in the accounting field, they have this kind of linear this line. They have this line. They draw this line, and this line means this is the very good. That means this is a good threshold between the company which has a high risk and the company which doesn't have which has a low risk. So that means this is a threshold between that. And we can find that this is not good. This is really not good. So this means company has no default risk. This means big default risk. This means low default risk, and this is big risk. So just use this line. And the researchers find that it's very simple. We only use this line to divide. It's very simple and very ideal. In that case, other method has been proposed to just determine, just to divide the good company and bad company. Good, bad means high default risk and or low default risk. And for the dividend reactions and the callable, I think this. I'll choose some exercises. You don't need to. The latter part of this chapter is not so important. It's about some story about CDS, and I will ignore this one. Let's move to the exercise. I'll give you 1 minute to read This is also original questions in the CPA level 1 test. In the level 1 test. How to calculate the YTM and realize the coupon yield. Realize the coupon yield. Okay, if you know the coupon rate and if you know the coupon rate, we can see that if you know the coupon rate and the bond price, that means how much you bought the bond price and the maturity year. We know that about every year different. Every year R1, 2, 3 is R1, 2, 3 are different. So could you please calculate the yield to maturity and realize the compound yield of the bond? In this case, of course, you can use your calculator. You can use calculator. You can use calculator to get this result. So I use this way. This is a simple way for calculator. TB minus, okay, N TB SV PMT. PMT is calculated by the coupon rate. So this can be easily solved by the calculator. And finally, we get the YTM is there. It's 9.88. This is the yield to maturity. And realize the compound yield mean that every year the R is different. So actually your final value is different. So every year you have R1, 2, 3, they are different. And you didn't get your money back, you still put it in the bank, then it will automatically invest in the next year. So in this case, we can see that this is the coupon rate. This is the coupon rate. You can get this kind of coupon every year. And this is first year. So R3. R2. So R2, R3. This is second year. So R3. This is last year. Nothing. Then we get the cash flow. We get the cash flow. And calculate it. Okay. And calculate. And okay, what here? And this is if you want $80. What is the what?
PMT 80. Where is it? Is it a constant?
I didn't understand your question. What
the
is
80? I'm trying to figure out the values from the data, right? The end is number of years, right?
You mean the question?
Yeah, the data you have to solve the question.
You mean this one?
Yeah.
Oh, just from the.
Yeah, that's the point. N is number of years. That's 3, right?
Three years, right?
Yes.
Now giving.
Yes.
Now actually is the fixed value.
It's fixed, yeah, that's
Fixed
the
value,
yeah.
yes. It's final fixed value. And PMT is the coupon rate, okay? It's fixed value is 1,000 and the coupon rate is 8%. So every year you can get the permanent cash flow. 80.
From the 80%.
Yes, 8% and the fixed value is 1,000. So 1,000 multiplies 8%. So that means every time you can receive the coupon rate
of
80. Okay, 80. So we can use the calculator, this one. And if you want to calculate this, I think you just need to know the initial value and the the final value and the initial value. Then just use one yield and you can calculate this. So this is the first one. And another question. This is also can be done by the calculator. Okay, consider bond payout coupon rate 10% per year semi-annually. This is semi-annually. 3 years semi-annually. That means you have the 6 periods for coupon payment because it's semi-annually, but only you have 3 years, so it will pay you 6 times. 6 times, okay? When the market interest rate is 4% per half year, and the bond has 3 years until maturity. So please find the bond price today and 6 months from now after the next coupon is paid. And second one, what is the total 6 months rate of return on the bond? If you want to calculate the first one, just use the formula of bond pricing. This is the formula of bond pricing. Directly use that. Okay, bond pricing formula, just directly use that. And don't forget the important parameters. First, the face value. Face value is 1,000, and the coupon rate you must face value is 1,000, and the coupon rate is 10% per year. So every time 50. 1 year 100, so half a year 50, and this is the face value. And for this one, this means you can find that the market interest rate is 4% per half a year, and totally 3 years. But you will receive it every half a year, so 6. Here is 6. This is the first time, and after 6 months. All the parameters are the same, except the same, right? The same, but you should change 6 to 5. Change 6 to 5, right? Because half a year passed, so we just change 6 to 5. And okay, initial value and final initial value. This one, final value. This one, initial value. This one. Then you can calculate your rate of return, and of course you have the book rates. Here's book rates, and you can calculate the rate of return is 4%. Is 4%. 6 months from now, after 6 months is passed.
Okay, so 6 months left in the year.
Here is 3 years. Totally, the bond has 3 years until maturity, right? But the coupon rate is paid semi-annually. So that means totally 6 periods. 6 periods. 1 year, 2 times. So 1 year. So totally 6 periods. Now 5 periods. Because half a year has passed. Okay? So you just use calculator to I think it's easy to understand, and by using the difference between YTN, realized YTN, rate of return, holding period return, maybe you will be confused about that. So the time is limited, so I suggest you to read this book of investment. It's very easy to buy this book. So if you want to know the basic rules in the financial markets, I recommend the investments. This book is very famous, and now it's in maybe 10th edition. It's by Body in the Boston University. It's very famous. I think it's the best book for understanding the financial markets. So if you want to know the another famous book is about options and futures. Another is about options and futures. But I think it's more complicated, it's difficult for you. So I suggest that you just read this book by yourself if you are interested on these financial markets. Also, Body. Maybe 3 authors for this book. Body. This is 9th edition by the 10th edition.
I can see the secret offer is maybe from your country. Yeah, the secret offer.
From your country?
Yeah, I can see it here.
Oh.
Well, you should say my name.
But what is from your country?
Yes, this one.
Second one.
Yeah.
In most of the time, after we can judge the country just from the name. But for Chinese, it's very difficult. We don't know the difference. But sometimes your name is very long, so it's difficult for us to read your name. Okay, the class is over, and if you have more questions, maybe you can read the whole book. I think because our time is very limited, and every professor only gave you 2 days class. So after that, maybe the next class will be given by Professor Hu and Professor Shu. Okay. So, thank you. That's my pleasure to discuss all very interesting things, share this with you.
老师，
Oh, no problem.
老师您好。
可以点名吗？需要点名吗？
我们线上的同学需要点名。
是需要点名啊。这个点名是我来点吗？是谁点名？
好像有班长，但是我不知道他今天来了没有，不知道。
班长。
好的。
这个应该老师他会截图嘛？所以
可以。拍个照片好了，我干脆拍个照片好了。对。
他们直接会在名单打上过。
对，因为今天好像没有签到，我拍张照片吧。我拍个照片。
好的。
好的。好 ，OK, thank you everyone. Maybe see you next time. I don't know when is the next time. Maybe someday, something in the near future. OK, bye bye.
是。